Hey, good morning, options traders, and I hope everybody had a fabulous weekend. Well, a question that we get a lot here is about the covered call, and rightfully so, because a lot of traders who become options traders come from a stock trading background. And so guess what they already have in the account? Shares of stock. So it's a natural extension to say for a first strategy, let's start out by selling some calls against these positions, and we can create a nice hedge. And that's the part that you have to be careful of, that this strategy is often touted as a hedging strategy. Is it? Well, it kind of depends. So let's go have a look. So first, understand that whenever we talk about hedging, we are primarily talking about reducing losses. Whether it's to the upside, to the downside, whatever position you have, if it is some type of an additional action, the purchase or the sale of an option to reduce losses, then yes, we could make the argument that it's a type of hedge. Most of your hedges are delta hedges, and I've talked about this in a previous video when I looked at the Greeks and which ones were the ones that you wanted to pay attention to most, the ones that would hurt you the most, and delta was number one on the list. If you're ever faced with a sizable loss on a position, in most cases it's going to be because of delta. So whenever we're hedging a position, we want to focus on delta. So that will be important in just a moment. Another thing to understand is that good hedges will reduce the most risk for the least cost. So that's something else to keep in mind. So let's look at a hypothetical covered call. Let's say that we buy shares of stock for 100. You sell the 105 call for $2, and that gives you a cost basis of 98 bucks. And that's because you spent 100, you received $2 back, so effectively you have paid $98 for your shares. Now with this information, we can also figure out that your maximum gain is 7. And a couple of ways we could figure that out. So first, let's say if the stock rises from 100 to 105, to the strike of that call you get assigned, that's 5 points that you could make. That's the maximum, but you also keep the $2, so there's 7. A second way to figure that out is to say if you've got a cost basis of 98 and you get called out at 105, that's $7. So that's the very most that this strategy could do. So keeping these reference points in mind, let's go take a look at a stock position purchased at 100. We've got unlimited gains up, unlimited potential losses down. And notice that the red line crosses right here at 0. That's because that's our cost basis. But now we sell the 105 call for 2. And if we do that, we switch from the red line to the blue. As I mentioned in all of the videos, notice that we get a bend right here at the strike. That's why we're bending at 105. And that shows we cannot make any more gains, at least at expiration, above 105. And because that's a $5 gain plus a $2 from the sale of the call, there's your $7 maximum gain. Notice that this blue flat line, that's the highest point on the graph, sits right there at plus 7. But part of the thing that you have to understand is that you're giving up all of these possible gains. Notice that the red line for the shares of stock could potentially make those, but you won't make those by using the covered call. So what you're really doing with a covered call is you're saying, yeah, I know that these are possibilities, but possibilities are not sure things. And I'm willing to give these up in exchange for $2 in the pocket today. So that's a look at the gains, but now let's look at the hedge. What have we really done to guard against the downside? Well, notice that our break-even point was 100 for the shares, but when we do the covered call, we have shifted this blue line $2 to the left. That's it. That is the maximum that we're going to get for a benefit for our delta hedge. But if the stock falls, we still retain 100% of the losses, just minus the $2 that we collected. So another way to look at it, let's say that you bought shares of stock for 100 and your friend buys the same shares for 98. So his break-even's on this blue line down here. Would you really say that he has this huge hedge compared to you? Probably not. You'd say, well, we're both long shares of stock. I bought him for 100, he has them for 98. You wouldn't really see it as a huge benefit. And yet, when traders enter into a covered call, they do. They think that it's some type of a huge hedge. So just looking at this graph, you can see that the delta hedge really isn't affected by a whole lot. Let's look at it with a current curve. Here is a covered call with a strike at 100. just to make the graph a little easier to read. And the red line is the current curve. And notice that it is bending downwards. It's as if somebody is pushing from the bottom of the screen upwards. And that is negative gamma. And what that means is that if the stock price rises, you will be selling shares. And if the stock price falls, you are effectively buying shares. So look what's happening. If you start out, let's say, with 100 deltas by buying your shares, and you sell, let's say it's an at-the-money option with a delta of 50. Yes, you do have a delta of 50 at that moment. And on one hand, you could say that is a delta hedge. You have sharply reduced your deltas. But look what happens once you've entered into the strategy. As the stock price rises, you are moving towards zero. Do you see how this red line is starting to get flatter and flatter and eventually will be? Just like this blue line up here at expiration. That means you have no shares left. And that's because you got called out at the strike price, whatever it may be. On the other hand, if the stock price falls down in this direction, you will eventually be plus 100 deltas. Doesn't matter that you started up here at plus 50. If the stock price falls, this option is becoming further out of the money and working towards zero, but you still end up holding the shares. So in that sense, you are accelerating deltas into a losing market, and you are decelerating your deltas into a rising market. And so that's really the outcome of having negative gamma, but you have to say, is that really a hedge? That we start out with maybe 50 shares of stock, but I'm going to be buying into a down market? This is where the losses are, and yet we are accelerating those losses. So is the covered call a good strategy? Well, it really is a matter of understanding what you're getting into. And is this the risk-reward profile that's best for you? So is a covered call hedged? Well, it really depends on how you look at it. On one hand, we could say, yes, we do collect some premium up front, and so we do get a small fixed dollar hedge. But in most cases, that's going to be very small. It's always by the amount of the extrinsic value, never the amount that you're out of the money. So in this example, we had a 7-point maximum gain. That's not a $7 hedge. That was $5 of capital gains, but we only got $2 for selling the call. It is $2 of a downside hedge in that example. So no matter what you receive, though, for the extrinsic value, traders are still wide open to the majority of the losses. And so that's why you have to really say the covered call strategy is not really a good hedging strategy. What you're doing is you are sacrificing future potential gains for a smaller immediate cash payment today. That's really the better way to see the covered call. But always remember, don't ever enter a covered call unless it's a stock you really like and have confidence in, because you still hold most of the risk. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.